This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, last time we left it with you looking at the share identification rules so far as a corporate tax problem was concerned. Like with individuals, when a company sells shares, the problem always is identifying which shares are now being sold. Unless you can do that, you can't determine allowable cost. And if you can't determine allowable cost, you can't determine the capital gain. So the idea was which shares are sold first. So when some but not all of the shareholdings that a company has in another company are sold, which ones are they? Not left to us to decide. It's those share ID rules. And what we saw last time was that we would firstly recognise those shares sold as being any acquired on the same day. Not a likely situation. More possible is shares acquired within the previous 9 days. If there were such shares, then those are specifically identified, what was their cost, and what part of the sales proceeds now on this sale belongs to those shares. Match proceeds with cost, you got the gain. No worries there when matching shares acquired within the previous 9 days. No worries with indexation allowance. It's not an issue, just proceeds less cost. Giving rise to gain, giving rise to loss, as the case may be. What we are going to spend most of our time doing, however, in any such problem, is going to the next and final port of call in terms of our identification rules, and that is the share pool. And I left you potentially, if you wish, to look at example 2, as we see here on our screen now. So how do we tackle such a problem? The requirement: calculate the gain, here arising on the disposal in March 2018. We can see just above that the company A Limited is selling 3,000 shares on the 10th of March 18 for £36,000. And for purposes of any indexation allowance calculations, the RPI in March 18 we're going to deem to be 280.1. Now, important issue. If you're dealing with the corporation tax question in section C, and this is one transaction that you have to deal with, the company in question has sold some shares during the accounting period, and we've got to work out what chargeable gain, probably gain rather than loss, has arisen during the period. So you know you're dealing with corporate tax. But on an objective testing question, each individual question is different from any other. So when you turn to a question and it deals with capital gains, first thing you need to identify. That is, who's doing the selling. Here in the requirement, it didn't specify, just calculate the gain arising on the disposal in March 18. So on an OT, an objective testing question, who's doing the selling? Here, A Limited. So we know, therefore, that this is corporate tax. What are we selling? Shares. So we know it's going to be the share identification rules that are being tested. When did the sale take place? Because by reference to that sale date, we'll then be able to determine were there any shares acquired on the same day, or the previous 9 days, or thereafter, anything before the previous 9 days, all goes into a share pool. We know the sales proceeds, £36,000, well, we have to divide that up amongst the different categories of share identification. If there were some acquired on the same day, if there are some acquired in the previous 9 days, how many were there, what part of the proceeds belongs to those shares. So let's look back at the history of acquiring. First of all, we're told that A Limited bought the following shares in B Limited, goes back all the way to August 89. Again, we'll need to know what was the RPI then for purposes of indexation, how many shares were bought, and the cost, £5,000. Now, clearly, that is not the same day, nor the previous 9 days. So that one, along with that one, the 16th of November 96, where 2,000 shares cost 12,000, those two acquisitions will be going to the share pool. But then we see this one, 7th of March 18. Disposal date, 10th of March 18. Yeah. Here's an acquisition within the previous 9 days. So what do we know about it? There were 500 shares acquired at a cost of £5,000. Here we are selling 3,000 shares. So what we now know is that the first 500 of those 3,000 shares there sold are deemed to be the ones acquired on the 7th of March 18. So now we do a specific gains calculation. I've not bothered about the RPI because any shares acquired in the previous 9 days, there is no indexation allowance. So what do we want? Sales proceeds. This is on 500 of the 3,000 shares that were sold for £36,000. So 500 over 3,000 times 36, 500 over 3,000 is 1/6 of 36, will therefore be proceeds of 6,000. What is the cost? We know the cost. There, 500 shares acquired at a cost of £5,000. Cost, 5,000. Take it away. There's our chargeable gain, £1,000. So the first part of the problem is resolved. On 500 of the 3,000 shares sold on the 10th of March 18, we're looking at a chargeable gain of £1,000. So that leaves us with the remaining 2,500 shares to deal with. Now, where did they come from? Well, the only other place could be the share pool. We know which two acquisitions, 20th of August 89, 16th of November 96, those two are destined for the share pool. How many are there? 1,000, 2,000, so 3,000 shares in total. 2,500 of those 3,000 shares are now being sold. So that demands, therefore, that we now put together our share pool. How do we set that up? 3 columns, number of shares, cost of shares, and index cost of those shares. Where do we go? We go back to the beginning and the first original acquisition. When was the first acquisition? It was August 89. So, August, that's an 8 there, August 89, the pen isn't working too good, acquisition here. How many shares? Just see it at the top. 1,000 shares at a cost of £5,000. And whatever goes in the cost column also goes in the index cost column, as we said at the end of our previous session. We then move forward to the next acquisition date, which is going to be November 96, at which point we re-index, before then adding in what will be the number of the then shares acquired. We re-index. How do we re-index? We pick up the RPI now at the date of this second acquisition. The RPI, oops, no, not that one. The RPI there for November 96 is 153.9. Indexing from either the last indexation or, of course, as here, the first acquisition, which was back in August 89. So, RPI now at this date, 153.9, minus what it was when we bought it. We'll get the question over here there, 115.8, all over 115.8, and we multiply that out by 5,000. That's the index cost. Again, going forward, that figure will be different to the cost figure once we've applied indexation, re-indexation to that. It's always the index cost figure that we re-index. So we work that through. Now, I can show you, therefore, on the answer guide, exactly what we have done here. So we've set up our share pool. We've put the information, as you have seen there, for the number of shares, cost of shares, index cost, the number of shares acquired. We've then done our indexation up to the date of the next operative event. That was a further acquisition. Before adding in that further addition, that acquisition, we do our re-indexation. There we go. RPI in November 96 minus August 89 over August 89 times 5,000. You'll notice there that there is no indexation factor. We do not round the result of the RPIs there, the re-indexation. Whatever that shows, multiply it through by the £5,000. That here would appear to be, but again, I might not have used this correctly. Do check that out, please. Make sure it's the right number. Re-index 1,645. Add it, we now get that higher index cost. Still 1,000 shares, cost 5,000, but the index cost is 6,645. Now add in that addition. How many shares? 2,000 shares. What was the cost? £12,000, and the cost goes both in the cost column and in the index cost column there. Revise our total at there the date of November 96. We have 3,000 shares costing £17,000 and with an index cost of 18,645. And that stays that way either till there's another acquisition going into the share pool, which there isn't because the only other acquisition was the 7th of March 18, and that we've already identified as being the first shares to have been sold. So what we must now do is to index up to the disposal date, which is March 18 there. Re-index through to March 18. When was the last time we re-indexed? That was November 96. What was the then RPI? 153.9. So we're indexing from then 153.9 all over 153.9. So you know the last time you re-indexed you went to 153.9. That now comes into this calculation as to when you're re-indexing from. What is the RPI now? 280.1 times the index cost figure. There is your index cost figure, 18,645. Again, put the numbers, the RPIs through your calculator, leave that outcome in your calculator, make sure you haven't got a rounding button on there at this point in time, and multiply by 18,645. All being well, if our maths are correct, that comes to 15,289. Add it in to your index cost column, it's there 33,934. 3,000 shares costing £17,000 and at the date of disposal with an index cost of 33,934. We now deal with the disposal. How many of these 3,000 shares are we selling? We know that we've accounted for 500 out of the 3,000 shares being sold on the 10th of March 18, so there was another 2,500 coming out of this 3,000 there. So we take out on an average basis 2.5 over 3, 2,500 shares sold out of 3,000 shares held, times the cost of 17,000 and the index cost of 33,934. Put those through your calculators. Hopefully we get a cost figure attributed to those 2,500 shares, and what appears to be there £14,167, and an index cost of 28,278. Again, if you're only asked to deal with this disposal, you're not interested in what balance of shares remains within this share pool, so there's no need for us to identify that. And of course, if you are doing it for an answer to an objective testing question, we can again be very brief in terms of the labels that we apply on this. As long as you get the right number, you've got to do it the right way, of course, as we're showing here. As long as you get the right number, though, it doesn't matter how you present that. Note that when re-indexing the index cost in the share pool, as we've kept on saying, we do not round the indexation factor to 3 decimal places. What may, however, happen in the exam, and this more usually happens as we'll see at the end of this chapter, when dealing with takeovers, to make life easier for you, not to trick you, not to make life any more difficult, but to actually simplify it. They may give you, the examining team may give you indexation factors from one relevant date to another for ease of calculation. If they provide you with those figures, use them. use the given indexation factors if provided. They're not trying to trick you there, just use the figures that they provide to you. Okay. Calculate the gain. The share pool does not calculate the gain. The share pool gave you the important information you needed, that of the 2,500 shares sold from this pool, what was their cost and what was the index cost. Now we show the gains calculation. So what do we need? On these 2,500 shares, the proceeds. There were 3,000 shares that were sold. 2,500 over 3,000 times proceeds of 36 would appear to be £30,000. What was the cost? There's the cost in your cost column on your share pool. In it goes. And so we get unindexed gain. Indexation allowance. What is that? This is why we did the index cost column. Now the indexation allowance is not the figure in the index cost column. That is the index cost of what is being sold. Here, 14,167 is the cost of those shares. So indexation allowance must be the difference between the cost and the index cost. So 28,278 minus 14,167 gives us, therefore, the indexation allowance. And as ever, take it away from the unindexed gain to give you the chargeable gain there. Here, £1,722. To get the total gain arising on this disposal, put the original 500 shares identified as being acquired in the previous 9 days, take their gain of 1,000, add in this 1,722, and we've got £2,722 worth of chargeable gain to now identify on the corporate tax computation of A Limited in relation to this disposal of shares in B Limited. Now you may be thinking in this calculation here, it would have been much quicker and easier to go 30,000 proceeds and then to go up to the index cost, that is cost plus indexation, and just deduct it directly, 28,278, and that would have brought you quickly down to the same answer, 1722. Now, if you're doing an objective testing question where you're not handing in workings, it's just about getting the right answer, then you can do that. If the answer still leaves you, as it is here, with a chargeable gain. If you're doing it in a written answer, and you are therefore showing your workings, do it this way. Now, the reason why, you might think, isn't it just quicker and easier, as we've seen, just to do this calculation? But there would be a problem if that figure of index cost was bigger than the sales proceeds, implying that there might be a loss. But there only might be a loss, because remember, indexation allowance cannot serve to increase or create a loss. That is why we go here with the cost figure and deduct it in getting any unindexed gain. If the cost was actually bigger than the proceeds, then at that point, the figure there would be your allowable loss. The best that indexation allowance can do, here the 14,111, the best that that can do is to reduce down what was an unindexed gain to a lower chargeable gain. It can't serve to increase or create a loss. So in a written answer, show it properly as we did here. If you're doing an objective testing question, and you can quickly see that the proceeds are bigger than the index cost, there, the 28,278, just take one from the other, and you've got your chargeable gain. Put that in as your answer, pick that out from, hopefully it's one of the 4 answers given there, and that's going to be the answer for that particular bit of the gain. Again, be careful there as regards what the specific requirement is. Do they want the overall gain, or for example, just the gain arising on the shares in the share pool? They can write any requirement they wish, read it carefully, and give them the answer. The overall chargeable gain, that's the most likely thing to ask for, 2,722. Of course, you're not going to have all of this work to do for 2 marks. You're not going to see both, I'd suggest, shares acquired in the previous 9 days and shares in a share pool where there were multiple acquisitions. That's too much work to do there in the space of the time available for 2 marks. But that's the basis of it. Okay. That done, let's just return to our notes here and to what is the next problem. As we said at the end of last session, there is more than one way of acquiring shares in a company, other than just buying more shares from an existing shareholder in that company. They don't want them anymore, I want them, I buy from the other shareholder. That's an acquisition. But we might acquire shares directly from the company that issues more new shares. And those issues can take the form of either, as we should know, a bonus issue or a rights issue. Firstly, the bonus issue. This is by far the easiest one to do. A bonus issue, as you should already know, increases the number of shares held, but there's no corresponding increase in cost. There's no change in cost. These are free shares, bonus shares, being issued by the company. In which case, all we do is the bonus shares are simply added to the number of shares column in the pool. It doesn't affect index cost. There is no re-indexation. Do not here index the cost of the original shares to the date of the bonus, as no new cost is incurred. So when dealing with the bonus issue, you simply add in to the number of shares, the number of shares acquired. There is no change in cost. There is no change in index cost. That's all you do. Add in the extra shares to the number of shares column. Now what that means, of course, is when you move to the next operative event, another acquisition, or indeed a disposal of the shares, then you must remember to re-index from the last time you re-index there, or from the original acquisition, if there's only been a bonus issue since then. You did not re-index at the time of the bonus issue. Now again, be careful. What the examiner will no doubt do is to give you an RPI at the date of the bonus issue. It's irrelevant. Don't use it. They might even, if they're not giving you RPIs, giving you indexation factors, give you an indexation factor to the date of the bonus issue. Don't use it. We don't re-index to the date of the bonus issue. We simply add in the extra shares acquired there. Before we look at rights issues, let's just have a little look at example 3 and see what is happening. Again, March 18 is the disposal date, and we've got to calculate the gain, this time for Y Limited. Y Limited is selling 2,000 shares in March 2018, March 18 for £12,000. Y Limited selling these shares in X Limited. Had originally acquired 3,000 shares in X Limited, July 93, there's the cost of £10,000. This time, what happened was a bonus issue, a 1 share for every 3 shares held bonus issue, 1 for 3, and that was in February 95. All we've therefore got to do is to set up now, as clearly there's no shares acquired on the same day or the previous 9 days of the disposal date, it is just a share pool. So you're going to set up your share pool. Number of shares, cost of shares, index cost of those shares. Number of shares, the first and only acquisition purchase of shares where a cost was incurred. Number of shares, 3,000. The date, of course, July 93. The cost, 10,000. And that £10,000 cost goes into both the cost column and the index cost column. What comes next? February 95. Bonus issue. No re-indexation. You own 3,000 shares. There's a 1 for 3 bonus issue. 1 for 3 on 3,000 is another 1,000 shares. Add that in to your number of shares column. Just add in the number of shares acquired on the bonus issue, 1,000 shares. Nothing extra in the cost column nor the index cost column. Next thing to happen, the disposal, March 18. Now we do re-index. We're re-indexing from the date of the original acquisition. That was July 93. So the re-indexation will be RPI now minus what it was at the date of the original acquisition, because though they gave us the RPI there for February 95, when the bonus issue took place, that is ignored. Ignore it. It is irrelevant. So the re-indexation, 280.1 minus 140.7 over 140.7. Leave it in the calculator and multiply it out by an unchanged cost in your index cost column, £10,000. Now, I'm going to whip through to the answer now and have a look at that. You, again, pause at this point. You try and construct that share pool for yourself, taking account there of that bonus issue. Okay, here we go, therefore, in terms of our answer to this. As we said, July 93 acquisition, number of shares, cost, and put the figure in the index cost column as well. February 95, a bonus issue 143. 1 for 3 on 3,000 shares held is, of course, the 1,000 shares that we see going in there. No change in cost, no change in index cost. It is simply now that we're deemed to own 4,000 shares. We do own 4,000 shares with a cost of 10,000 and with an index cost of 10. The indexation occurs at the date of the next operative event. There were no further purchases of shares, and therefore it's the disposal. Pick up the relevant RPIs at the date of disposal over what it was at the original acquisition date, July 93, all over that self-same figure. Put it through the calculator times 10,000, that would appear to be 9,908. That gives us an index cost of 19,908. Now we deal with the sale at this date, that date being March 2018. How many shares are being sold? 2,000 shares were sold out of 4,000. We therefore take 2,000 over 4,000, 2/4, 1/2 of the cost of 10,000 equals 5,000. Of the index cost of 19,908 is hopefully 9,959. Once you have those numbers, they feed into your gains calculation. What were the proceeds? £12,000. What is the cost? £5,000. What is the indexation allowance? The difference between the index cost of the shares now sold and again the cost of those shares. 9,959 minus 5,000. Again, the difference between these two figures here. That would appear to be 4,959. Take it away from the unindexed gain. We now have our chargeable gain. Bonus issue, easily dealt with. Remember, with a bonus issue, no re-indexation, just add in the number of shares acquired. Once you've calculated, of course, on the terms of the bonus issue, add it to the number of shares column. As distinct from, if we are dealing with a rights issue. Here, if we've got a rights issue. What does a rights issue do? Well, again, it gives you more shares. The company is issuing more shares. Again, the number of shares you get is a direct result of how many shares you already own there. But the big difference. This time, of course, the rights issue obviously makes far more sense to us here as to what they're doing. The company is raising fresh share capital, new share capital. And it's going to its existing shareholders for that share capital. And they will gain that share capital as long as the shareholders decide to take up their rights to that rights issue. So a rights issue will again increase the number of shares held. But this time there is a price to be paid for each of those shares acquired under the rights issue. So there's going to be a cost that is associated with the shares. It is therefore dealt with in exactly the same way as any other acquisition, other that is than the bonus issue, any normal acquisition of shares, any other normal purchase. So what do? The index cost in the pool is indexed to the date of the rights issue. Whatever was the last figure on your index cost column, that is the figure that is now re-indexed. We index it through to the current date of this rights issue. We then add in the number of shares acquired. Once you've calculated what that number of shares is, they'll tell you what the terms of the rights issue are and how much you paid for each share. So you can work out the number of shares and then the cost. That cost, of course, is then added to both the cost column and the index cost columns, just like you do on any normal purchase of shares in the company. The only problem that you face here, as we know, is actually working out how many shares are required under the rights issue. Is it 1 for 2, 1 for 3, 2 for 3, 2 for 5, whatever it might be? Again, be careful to interpret that correctly. Such as we will see here in, we don't see here an example 4 there, but again, we could have a simple little exercise on that by simply changing, we just got takeovers there. Yep, by just changing, therefore, what we had in our original example here. Let's just use this as a model. Just clean that up for us. What we'll now assume here is that the issue that we had, rather than a 1 for 3 bonus issue, was now a rights issue. And what you would be told is something like 1 for 3, 1 share for every 3 shares held. Now we'll remember number, cost, and index cost columns. We knew that we had on our original acquisition 3,000 shares that cost £10,000. Exactly as we had before. Now, when we see that it is a rights issue, that will mean that we need to re-index. From the last acquisition date, that acquisition was July 93, through to the date of this rights issue, which is February 95. So we'd re-index. We'll do that. Well, you'll do it on your calculators in a moment's time there. And then we'd be adding in the impact of the rights issue, 1 for 3 at. So what now with the price of those shares? Let us assume, therefore, now that the price of the shares has gone up to, say, £5 a share. Didn't it do well? At £5 per share. So 1 for 3 would be 1,000 shares at £5 a share would be £5,000. Anything in the cost column also goes in the index cost column. That means, therefore, there's one thing now further for you to do here, and that's the re-indexation. So, what is the RPI at the date of the rights issue? The rights issue being February 95. That RPI now is 146.9. 146.9 minus, what was it when we acquired? 140.7 all over 140.7 times. What is the figure in the index cost column? It's £10,000. So work that out for me and then establish what are the balances on your share pool back in, where are we, February 95. So again, pause at this particular point and go find that information. Work that one through. That's the missing figure there. Okay, well, hopefully, therefore, you've done the same calculation as I have. Again, depending on how accurate my use of the calculator is. And when we've re-indexed that index cost of 10,000, I got it to £441. Again, we know the basis of the calculation. That's the main thing. Hopefully the outcome is 441. We can now revise our totals. We've now got, following that rights issue, 4,000 shares in the share pool with a cost of £15,000 and an index cost revised up to 15,441. What happens next? There's no other purchases that take place, so you go all the way through to the disposal date, which is March 18. So in March 18, therefore, you will need to re-index. So again, I'd like you to pause at this particular point in time and go do that re-indexation there. Once you've done it, come back and then we'll deal with that disposal. So all being well, when you've worked out there your re-indexation, updating to March 18, where it's 280.1 from what was now the last time you re-indexed. That was back in February 95, where you brought up that index column to the indexation, the RPI factor of 146.9. Now, therefore, indexing from there through to date of disposal times the total that you have on your index cost column, 15,441, is hopefully, therefore, 14,001. And at that point, we then recompute how many shares at what cost and index cost lie within that share pool. As we can see there, 4,000 shares, cost 15,000. That hasn't changed, of course, now, but the index cost has gone up hugely. Again there to £29,442. So with that information, you've then got to deal with the disposal. So deal with the disposal, therefore. We were told that Y Limited sold 2,000 shares. That is 2,000 out of this 4,000 shares here. And they were sold for £12,000. So you now do your gains calculation on this and see what you get. So again, please do pause at this point. I want you to do that calculation and see what you come up with. Be careful, you have been warned. Okay, let's see if we've got what the answer should be here. Now we know the sales proceeds, 12,000, always going to be given, of course, in the question. We've worked out from our share pool that we've sold half of the 4,000 shares, 2,000 of them here, so we take with it half of the cost. Bringing down, no need to label it, but you do need to know what it is, the unindexed gain of £4,500. Indexation allowance, the cost of those shares now disposed of, 7.5. The index cost of those shares, 14,721. Now that would give you indexation allowance here of over £7,000, 7,221. Now you put that in, if you like, 7,221, but what you have to understand is, what is your bottom line? Do we get a loss as a result of this? No, you don't. There is simply a nil chargeable gain. Remember, indexation allowance can't, therefore, create a loss. That's why, if we had shortcut, there was a danger that you might have gone, proceeds 12,000 minus index cost from the share pool 14,721 is a loss of £2,721. No, there is no such loss. Now we have to check out to make sure that there isn't an allowable loss here, but that would only be the case if that cost figure, here 7,500, was greater than those proceeds of 12. Only then would you have an allowable loss so far as the company is concerned on this disposal. So the indexation allowance can only bring down the unindexed gain to nil. Again, if you were doing a written exercise on this in section C, then what you'd say, of course, is that that allowance would be restricted there. And what you could do, if you wish, rather than putting 7,221 in, is put £4,500 in. The main point is that you show nil there. Whether you've shown the full figure of indexation or the restricted figure really doesn't matter. What is critical is that that nil chargeable gain arises. Okay, that's enough for this particular session. What we'll do, and the only thing we've still got left to do in terms of shares on corporate disposals of shares anyway, is to look at takeovers. Again, would be worthwhile if you have a quick look back at what we did when looking at CGT for individuals and the rules that applied on takeovers before we see you again next time.